Welcome to the Deep Dive. Today we're pulling up the hood on the Q2 2025 earnings call for Summit Hotel Properties. That's ticker INNN.
Right. This call happened pre-market back on August 6th.
And our goal here is pretty clear, isn't it? We need to unpack how they managed this, well, let's call it a tricky quarter.
Yeah, exactly. We're looking at their main operational plays, their capital strategies, because there's this real split we need to understand.
A split? How so?
Well, you've got softness on the top line, revenue and pricing, but then surprisingly strong cash flow. Resilience is the word.
So how did they prop up the bottom line when revenue was kind of wobbling?
That's the mission. Let's figure it out.
Okay, let's kick off with those headline numbers then, because yeah, they really do tell a tale of two companies here.
They certainly do.
First off, the market saw some trouble right away. GAAP EPS. That was a miss. A loss of 2 cents when the street expected a 5-cent profit.
Ouch. And revenue wasn't much better. It came in at $192.9 million, below the consensus range. So, yeah, misses there.
So if you just stopped reading there, you'd think, okay, the stock probably took a hit.
You would. But, and this is really the key, adjusted FFO per share, AFOA, that actually beat estimates.
Ah, the metric REIT investors really watch for cash flow.
Precisely. They delivered $1.27 per share, while the consensus was looking for $0.26.
Okay, so less money coming in the door than expected.
Right.
But they managed the money they did get so well that their main cash flow number looked better than planned.
That's it in a nutshell. Which explains the market reaction, right? It was kind of cautious at first, maybe neutral.
Understandable, given the misses.
Yeah, but that FFO beat, it really put a floor under the stock initially. It showed strong internal controls, good management.
So they used expense discipline to kind of fight back against those external pressures.
Exactly. And that let INN catch the updraft when the whole sector rebounded later. It was like a wind snatched from the jaws of, well, maybe not defeat, but a tough situation, a win from the inside.
Okay, let's dig into those external pressures then, because you said they were significant.
Oh, yeah. Same store RevPAR, revenue per available room, fell 3.6%.
And the key is why it fell, right? It wasn't empty room.
No, that's the fascinating part. Occupancy held up really well. It was 77.6%, down only slightly, like 40 basis points. That's actually near their second highest occupancy level in the past 5 years.
Wow. So high occupancy, but falling RevPAR. That points directly at the price they could charge.
Bingo. The problem was almost entirely the average daily rate, the ADR. That fell 3.3%.
So what drove that rate pressure?
Well, first you got to look at the comparison to last year. Q2 2024 was just loaded.
Right, I remember hearing about that. It was like a perfect storm of events.
Exactly. You had the solar eclipse drawing crowds, both NCAA Final Fours, the U.S. Olympic trials, and the Kentucky Derby happening at the same time as the PGA Championship.
That's a lot.
It's huge. Management put a number on it. They figured those specific events created a 125 basis point headwind on RevPAR this year, and it affected over 30% of their hotels.
So just comparing year over year, put them behind the 8 ball from the start.
Absolutely. A massive structural disadvantage for Q2 25.
Okay. Beyond the tough comp, what about the demand picture this year? Any specific weak spots?
Yeah, they pointed to some, let's call them unfavorable shifts. Government demand dropped off sharply, over 20% compared to last year.
Okay.
And international travel was also down, maybe around 18%. These are segments that, often pay a bit more.
So the mix shifted away from those potentially higher paying, stable government or corporate folks towards leisure travelers.
Seems like it. And that connects to the other point they made, heightened price sensitivity. The consumer's just behaving differently now.
How so?
They mentioned that almost 2/3, 65% of their transient bookings, like your regular travelers, are happening within just 2 weeks of the stay.
Wow, that's a really short booking window.
It is. And when people book that late, it really ties the hotel's hands on pricing. You can't really yield manage effectively. You end up having to offer deals just to fill those last few rooms, even if overall occupancy is pretty good.
So, tough comps, a nervous price shopping consumer booking last minute. Yeah, sounds like a difficult operating environment.
For sure. But this is exactly why that AFFO beat is so impressive. It brings us back to the controllable stuff. Their expense discipline.
Right. Despite RevPAR falling, their operating expenses year to date were up only, what was it?
A mere 1.5%, which when you think about inflation, wage pressures everywhere. That's pretty remarkable.
Yeah, that's tight control.
And if you look at it per occupied room, it's just a 2% increase. That tight-fisted cost control is what really limited the damage to their hotel EBITDA margin. It only compressed about 266 to 289 basis points, softened the blow from the lost revenue,
But I hope they pull it off, especially on the labor side. Wages are going up everywhere.
They managed it incredibly well. Their own hourly wages, not counting contract labor, were up only 1.2%.
That's really low.
It is. And maybe even more importantly, they're cutting back on that expensive contract labor, down 13% year over year.
Still room to improve there, though.
Yeah, they noted it's still about 250 basis points higher than it was back in 2019. So yes, potential for more savings as they bring more functions back in-house or just get more efficient.
But you mentioned something else hidden in the numbers that speaks to operational quality.
Ah, yes. The turnover rates for employees. They're down nearly 40% from those peak COVID-era levels.
And that matters because
Lower turnover means happier, better trained staff. It means more efficiency, less disruption, and you're not constantly spending money finding and training new people. It's a sign of a stable, well-run operation, and that definitely helps keep costs down and service quality up. It's foundational.
Okay, so tight cost control helped offset the revenue hit. Let's pivot to the money side capital strategy. They weren't just playing defense on costs, were they?
Not at all. They were actively working to strengthen the balance sheet, which is crucial in this higher interest rate world.
What did they do?
Really smart debt management. They repriced two big loans, their $400 million JV term loan and a $58 million loan on their Brickell property.
Repriced how?
Yeah.
Better rates.
Better spreads. They cut the spread over the benchmark rate, SOFR, by 50 basis points on the big one and 40 basis points on the other.
Okay, translate that into dollars and cents. What's the impact?
They estimate it saves them about $2 million in interest payments annually. That's basically free cash flow generated just by managing their existing debt smartly.
Nice. And the bigger picture on debt?
Even better. Because of moves like this, they now have zero debt maturing until 2028. That's a long runway.
Wow.
And they've got over $310 million in liquidity. That kind of financial flexibility, that cushion, is hugely valuable right now. Lets them be opportunistic.
And opportunistic they were. Used some of that flexibility for share buybacks, didn't they?
They did. Bought back 3.6 million shares, spent about $15.4 million. The average price was around $4.30 a share.
Okay, buying back stock when it's maybe under pressure. Makes sense. But you highlighted the math on this.
Yeah, this is the really clever part. At that $4.30 price, the implied dividend yield on the shares they bought back was 7.4%.
7.4%. And how does that compare to their borrowing costs?
That's the kicker. It's about 120 basis points higher than what it cost them to borrow money after those refinancing deals.
Wait, so they're borrowing money effectively cheaper than the return they're getting by buying their own stock.
Exactly. It means those buybacks are immediately accretive to cash flow per share. They're essentially creating value out of thin air through smart financial engineering. It's a really strong signal from management, too.
Okay, strong financial footing, smart capital allocation. But back on the ground, at the hotels themselves, were they just managing decline or actually winning?
They were winning market share. Management made a point of highlighting their RevPAR index.
Right. The index compares their performance to their direct competitors. What was the number?
It grew by almost 150 basis points, hitting 115%.
So 100% means you're getting your fair share. 115
means they're significantly outperforming their local competitors, capturing more than their fair share, basically stealing customers. Management said it's one of the highest levels they've seen since the pandemic. It shows their properties and their teams are executing really well.
And is that driven by specific assets or strategies?
Partly, yes. We have to talk about Onera Fredericksburg. It's their sort of unique, high-end experiential property.
Ah, yes, the one they just expanded.
Right. They finished adding 23 units, so it's up to 35 units now. And the economics there are just different.
Different how? High margin.
Very high margin. Before the expansion, Onera was pulling in a RevPAR of $360, way above the portfolio average, and running hotel EBITDA margins around 50%.
50% margin, wow.
Yeah, it's a much leaner operating model.
Yeah.
And they expect the expansion units to generate low to mid-teens unlevered yields.
So why is an asset like that doing so well even in this environment?
Well, it's targeting a different customer. It's that experiential leisure traveler, maybe less price sensitive, definitely not tied to corporate or government budgets. It's more resilient.
And management sees this as a growth path.
They explicitly called it a natural extension. It's about building a proprietary platform, moving away from being just another select service hotel chain towards something more unique, more focused on that high-margin leisure demand. That's a key strategic shift to watch.
Interesting. Were there any traditional markets doing particularly well?
Yeah, they call that Frisco, up in the Dallas area. RevPAR there grew almost 4%.
Nice. Was that occupancy or rate?
All rate. ADR gains drove the whole increase.
And Frisco has some future growth drivers too, right?
It does. You've got that Universal Kids Resort planned for 2026, plus a convention center expansion. Those should provide a nice long-term boost for demand and pricing power in that market. Shows they're well-positioned geographically too.
Okay, so lots of positives on execution strategy, balance sheet, but now the reality check, the updated guidance for the full year.
Right. Given the Q2 pressure and how Q3 is shaping up, management now expects the key metrics, adjusted EBITDA, adjusted FFO, they're likely to land modestly below the low end of the guidance range they gave before.
So a guidance cut, basically.
Essentially, yes. But here's where you tie it all together. That downgrade. It isn't nearly as severe as you might expect just looking at the RevPAR miss.
How so?
Well, think about it. The RevPAR growth is tracking maybe 200 basis points below what they initially targeted at the low end. That's a decent chunk of revenue they didn't get.
Okay.
But because of that really aggressive cost control we talked about, and because those share buybacks are boosting the per share numbers, the actual FFO and EBITDA targets are only expected to be down maybe 1 or 2% from the original low-end numbers.
Ah, I see. So the operational and financial levers they pulled significantly cushioned the blow from the weaker revenue environment. They stabilized the ship.
Perfectly put. They stabilized the ship against a pretty strong headwind. The top line missed by more than the bottom line is now expected to.
And looking forward, any optimism?
Management does expect things to get better in Q4. And the big picture, longer term, has a definite silver lining: a lack of new supply.
Right. Hotel construction has been muted.
Very muted. 2025 is likely the second year in a row where new hotel supply grows less than 1%. That's like half the historical average rate.
And why does that matter?
Because when demand eventually does fully recover and pricing power comes back, that lack of new competition means existing, well-located, well-run hotels like INN's portfolio should benefit disproportionately. Scarcity value.
Makes sense. And any other strategic moves mentioned? Dispositions?
Yep. They confirm they're focused on being net sellers right now. They've got 2 non-core hotels under contract to be sold.
And the cash from that goes towards?
Funding more of those accretive share buybacks and continuing to pay down debt, reinforcing that balance sheet strength.
Okay, that covers the call pretty thoroughly. Before we wrap with the final thought, it's time for our This Is Not Financial Advice segment. Let's get the disclaimer out first.
Absolutely.
Yeah.
Please remember, everything we discuss here is purely for informational and entertainment purposes. We are not financial advisors. This is an investment advice. Do your own research.
Got it. So based on everything we've heard, the revenue miss, the FFO beat, the balance sheet moves, the Onera strategy, what's the outrageous but plausible trade idea this time?
Okay, I'm thinking a paired trade. You go long in and you short one of its peers, maybe another select service focused REIT, or even just a broad hotel or real estate sector ETF like VNQ.
Okay, a pair trade. Long in, short the sector, or a peer. What's the logic? Why short the sector if INN is managing okay?
Well, the short leg is your hedge. Management themselves flagged that the current environment is tough. RevPAR is tracking below expectations sector-wide. Peers are seeing similar pressures. Estimates are getting cut. So you hedge against that continued macro weakness.
Right. Protect yourself if the whole tide goes out further. So why INN on the long side? Why bet on them specifically?
Because, as we've discussed, INN has built this really solid floor under itself. That balance sheet is fortress-like. Now, no maturities till 2028, lower interest costs, tons of liquidity. That provides downside protection.
And the upside
Comes from that execution and strategy. The capital allocation buying back shares yielding 7.4% is just brilliant, very accretive. Operationally, they're taking share. That 115 RevPAR index proves it. And critically, they're building out these specialized high-margin assets like Onera.
So the bet is that INN's specific strengths, financial discipline, market share gains, unique assets will allow it to outperform its peers, especially when the macro environment eventually turns relative strength.
Exactly. You're betting on superior execution and a differentiated strategy within a still challenging sector. It's a play on quality and smart management.
Makes sense. It captures that core conflict we started with, navigating the soft demand through really strong financial and operational discipline. They turned that potential top-line disaster into a respectable bottom-line beat on FFO.
Which brings us perfectly to that final provocative thought for you, the listener, to chew on.
Lay it on us.
Given everything we've seen, management's clear focus on these lower labor, higher margin, unique assets like Onera, how much extra value, how much of a premium should you put on a REIT that's actively building its own proprietary experiential lodging platform? How does that compare to a company just sticking to the traditional, maybe more commoditized select service hotel model?
Is INN evolving into something fundamentally different, and does the market fully appreciate that yet?
That's the question to ponder.
A great place to leave it. That wraps up our deep dive on Summit Hotel Properties Q2 call. Keep an eye on those monthly RevPAR numbers, how they handled the debt coming due in 2026 eventually, and whether those asset sales close as planned.
And remember, do your own homework.
Absolutely. This has not been financial advice. Thanks for tuning in, and we'll catch you on the next deep dive.